Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we are in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate.
Okay, that's a long bunch of finance nerd ways of saying that they didn't raise the rates, which is good, right? It's good. We should be happy. Let's ask Carol if we should be happy. The great Carol Roth joins us now, author of the great new book that's going gangbusters. You will own nothing. If you want to know what these WEF globalist freaks are doing to you, go buy the book. Carol, okay, they didn't raise rates. That's a good thing, right? There's no way that can be a bad thing.
I love how you sort of slipped in that I'm a finance nerd in there. I'll take it, Jesse. I'm okay with my nerdy moniker. I am a nerd. Listen, I think this was a prudent thing to do, but I don't know that it is the end of the Fed's hiking cycle, and I'm not sure that they're going to be able to handle what's ahead, because even though we have a slower growth rate in inflation, we still have sticky inflation, and sometimes correlation isn't causation. So a lot of what we're seeing, I don't think has actually been impacted by Fed policy. In fact, coming out of 15 years of highly historic suppression of the interest rates and $9 trillion added to their balance sheets, and they're messing and manipulating with the market, I don't really think that what they have done has even begun to work its way through the economy, nor do I think they have addressed things like the fiscal deficits, which they can't address directly, but they could certainly wag a finger at the president and Congress, which they refuse to do, nor our energy policy, because while they can print dollars, they can't print oil. So, a pause was definitely warranted, in my opinion, and maybe we'll give the debt and deficit a little breathing room in terms of refinancing, 25 basis points worth. But, we're not out of the woodwork yet. And certainly in this thesis of a soft landing, will they be able to get inflation down to what it is they want without tipping the economy into a recession? I don't think that we're out of the woods on either side of that.
Speaking of soft landing, he brought that up yesterday. Here he was.
I've always thought that the soft landing was a plausible outcome, that there was a path really to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened. Apparently, ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible.
Okay, so Carol, what is that supposed to mean? I hate the way all these people talk. I mean, the soft landing is very possible. It's kind of possible. It might be possible. It's narrowed. Wait, it's widened, but it's narrowed again, but it's kind of possible. Anyway, we'll see what happens. What is he saying?
He's saying a whole lot of nothing. That was the biggest bunch of gobbledygook that I've ever seen. It's very interesting. As I said, on the inflation piece, there are a couple of issues that I do think are a challenge for inflation. Obviously, the fiscal policy, the debt and the deficits, given the fact that we have these crazy high rates. We have $7.6 trillion in U.S. government debt that is coming due that needs to be refinanced in the next 12 months. And that's going to be at rates that are hundreds of basis points higher than what it was financed at previously. So that means hundreds of billions of dollars of incremental interest on top of what we're already paying for all the debt we've already incurred, not to mention the fact that we have these huge deficits. We're talking about almost $2 trillion is the projection from the CBO for fiscal year 2023. So the fact that continues to need to be financed could end up in and of itself creating an inflationary cycle. And then, Jesse, let's just pray that we don't get a cold winter either here in the US or in Europe, because that's going to send already high oil prices, higher perhaps to the levels or even beyond the levels we saw last year. So those are the kinds of things that can continue to stoke inflation. So, that's one piece of the puzzle. And then on the recession side, you have a strong quote unquote strong consumer in terms of the consumer has been spending on a regular basis, but their balance sheets are getting wrecked. They've been dipping into their savings. The personal saving rate is down below historic levels. It's at 3.5%. We have record household debt of 17.1 trillion. We have student loan debts that are kicking in. But strangely enough, that even if you get some break in the jobs market, the consumer starts to roll over, it doesn't necessarily mean we're getting a recession either, because the government spending is now taking up even more of the GDP. So that could balance out. And these other sticky pieces of inflation could, kind of counteract what's happening with the consumer. So we're in very weird, unprecedented times. And what you might think is a normal outcome from a certain set of things happening isn't a guarantee here. And that's why you're hearing the gobbledygook from the Fed, because they're panicking. The one thing we're not hearing from them is, oh, sorry, it's our fault. We helped cause this, and we feel real badly about it. So we're definitely not hearing that.
Was printing $7 trillion wrong? Was that our fault? Sorry about that. Carol Roth, thank you so much. I appreciate it.
Thanks, Jeff.